And hello, my colleagues, and I hope everyone's having a wonderful Saturday morning. I want to pick up where I left off on my last video, and we're up to finding the present value of an annuity due. Okay, and just to remind everybody, an annuity due means the payments were going in or coming out at the beginning of the period. Okay. So you're finding the present value of a series of cash flows that went in at the beginning of the period, and they're telling you what the lump sum today would be worth. Okay, so you're saying, okay, if I basically were putting in $1,000 a month at the beginning of a period, every month or every 2 weeks for 20 years, what would that be worth today? And this is the lotto problem. You ever notice when you buy a lotto ticket, they ask you if you want payments or lump sum? Well, the present value is, and it's always lower the present value because they're assuming it's going to be reinvested. So this is the present value of an annuity due. Okay? So because the cash flows of an annuity due occur at the beginning rather than the end of the period, we discount each annuity due cash flow one fewer period than an ordinary annuity. Okay? So here's the equation of the present value of an annuity due. And, you should put all these equations on your sheet so you know them. Okay, so it's very similar to the, to equation 5.4 here, right? Of an ordinary annuity. And now I'm in trouble here. Let me scroll down. Here we are. All right. And here's a nice personal finance example of how, and they're using a financial calculator, which I believe if you click on this, you see it. It's active. You can bring up the calculator here. And I believe there was a calculator that was clickable and usable somewhere in here, right? They actually gave you a calculator to use. I remember the last time we did this, there was a usable calculator. All right. So anyway, here's the spreadsheet, the timeline version. Okay. Oh, wait a minute. I'm on the wrong thing. Sorry. Here we go. Present value of an annuity. Here's the timeline coming back to the present. See the cash flows coming back? Okay. Here's the cash flows coming back. Here's the calculator now. And here's the Microsoft Excel spreadsheet. And once again, if you just bring up PV, right, and you could come up with these numbers. If you need any help, just get a hold of me, and I will help you with this. And okay, and you should have no trouble with that. Oh, so here you can open up the financial calculator, right? So let's do that. There you go. And it's usable, right? It's usable. So you have that to work with. Okay, so here's now where they compare an ordinary annuity and an annuity due present value. Okay, so the present value of an annuity due is always greater than the present value of an otherwise identical ordinary annuity. So this is the important statement that's being made here, okay, my colleagues? So it's important you know that statement, right? We can verify this statement by comparing the present value of two annuities. So here's the two annuities, right? Ordinary and okay, so and then they go through the math here. Okay, so let's move on now to the next word that we have to know, a perpetuity. And you'll notice the word perpetuity is basically very similar to the word perpetual. So that means you're going to get a perpetual payment forever. So a perpetuity is an annuity with an infinite life. In other words, it is an annuity that never stops providing a cash flow at the end of each year. Okay? So it goes on. And so the important words here are an infinite life. All right? Whoops, come on. So let's see if I can get that to highlight there, right? A number of business and personal investment decisions involve payouts that occur forever into the future, like a pension, right? And therefore excellent applications of the idea of a perpetuity. Fortunately, the calculation for the present value of a perpetuity is very simple. Here's the equation. The present value, you take the cash flows and you just divide it by the interest. It doesn't get any simpler than this. Basic division. Okay? And here's the interesting personal finance, again, example of it. And they go through the math, and it's first grade mathematics here. So that's all you have to worry about. Now, sometimes a perpetuity will grow. So what they have here is a perpetuity of a cash flow stream that's a perpetuity, but it will grow occasionally. So we're going to call this a growing perpetuity. And you'll notice they have a letter there in the equation below, G, and G is the growth rate. Okay, so let's look for that. So after a certain period, there's a constant growth rate forever. Okay. All right, so here's now again, the equation's very simple. The present value would just be the cash flows you're going to get forever divided by the interest you're going to receive minus the growth rate. Okay. So again, that should have been easy. And here's the personal finance example of the growth rate. All right, so here's some more review questions, which you should do to get comfortable, right? And basically, I believe we will move on to now things called mixed streams. So we want to talk about a mixed stream now. So a mixed stream means that there's cash flows that have no rhyme or reason. They're all mixed up, different amounts, different times, and they're going in here. So and again, you can see the definition here. I'll click on it. It's a stream of unequal periodic cash flows that reflect no particular pattern. And those are the magic words, right? So let me highlight that. There's no particular pattern and how they're going. Financial managers frequently need to evaluate opportunities that they expect to provide mixed streams of future cash flows. All right. So here's an example, and you can look at these cash flows, right? And different values, right? Different. You can see they're all different. Actually, this is going in periodically, though, but I don't know. Did they say periodically? Oh yeah, they are. I'm sorry. So the dollar amounts are unequal, but they're periodic. All right, they're periodic. So I apologize for that. So here they are going in periodically at different, and you notice they're all different. So here's the future value. You can see they do each one. You can do each one separately. And again, if you have any questions, just email me about that. And the calculator here will let you do it again. And here's the spreadsheet version. I believe you got to do this longhand with the spreadsheet because you see you got to use the cash flow. Basically here you're using future value and a net present value here. You got to use the net present value function here, okay? So if you go into Excel, do a search for NPV and you can enter the data just like this, and then you could future value it back, okay? So you could do it that way, or you can enter it. Okay, you can enter it manually. All right, and then of course, if we have future value of a mixed stream, we're going to have present value of a mixed stream, right? You always know now, where you see the word future or present, you'll see the other. And again, here's some cash flows, and now here's the opposite timeline. You see the money coming back, right? You see the money coming back. And once again, you see the pattern. Here's the calculator, here's the spreadsheet. All right, let me run this nice video here, and let's see how what this does for us. Okay, we'll add this to the mix.
In business, there are many situations when a firm pays out cash up front to undertake some investment, and then over the next several years, the firm receives a mixed stream of cash inflows resulting from the investment. The question that these businesses must grapple with is, given the forecasted cash inflows that are expected to be received over time from the investment, how much should the firm be willing to pay now? Here, the freight company projects that it will receive a series of cash inflows over the next 5 years of $400, $800, $500, $400, and $300. This pattern is not at all unusual. Many investments that firms make produce cash inflows that grow for a few years before gradually declining. What Freight's financial managers must determine is how much this mixed stream of cash flows is worth to the company today. The key to finding that answer is knowing what rate of return Freight can earn on other investments. In this case, we are told that Freight can earn at least 9% on investments that it makes. To determine how much Freight should be willing to pay today to acquire this future stream of cash inflows, we simply calculate the present value of each cash inflow and then sum the individual present values. For example, the $400 that Freight expects to receive in year 1, when discounted at 9%, has a present value of $366.97. Similarly, the present value of the $800 cash inflow that Freight expects to receive in year 2 is $673.35. You can see the present values of the other 3 cash flows in this example. Rather than setting up each present value calculation separately, you can set up one calculation that accounts for all the individual cash inflows. Adding up the present values of all 5 cash inflows, we find the total present value is $1,904.76. This is the most that Freight should be willing to pay today to generate the future stream of cash inflows described in the example.
So that was a good example. And again, here's some review questions, and here's some Excel exercises you can do. So, all right. So sometimes money gets compounded in the bank more often than annually, right? So when you put money in a savings account, the first thing you're going to ask them is, how often do you compound my money? So what you want to do is earn interest on interest, right? Is everyone aware of that? I hope everyone's aware of that. So you see what it says here. Interest often compounds more frequently than once a year. Savings institutions compound interest semi-annually, quarterly, monthly. Well, you're not going to get it. You're not going to get it monthly, weekly, or daily. So you can forget about that. Most of the time, it's quarterly. All right. Most of the time, you'll get quarterly interest. And anyway, you're only getting, what are you getting in the bank annually? 0.1%, whatever. So semi-annual compounding means you're going to get your money compounded every 6 months. Okay? Everyone should know semi-annual means every 6 months, or there's 2 compounding periods. Okay? So that's 2 compounding periods. Okay? So here's a personal finance example, and it's important you go through this personal finance example here to see exactly what that means. You can see you're collecting a little extra money because of the extra compounding periods. Okay? And here's quarterly, which means it's compounded 4 times a year, which means every 3 months, every 3 months. So you can see that. And they go through that example here. And now they compare here's the annual, the semi-annual, and the quarterly compounding. You can see you get more money with the higher number of compounding periods. And that should be obvious to everybody, right? You notice how this is getting larger? All right, so here's the equation for compounding. And it's important everyone knows this. Okay, so here's the equation for compounding. And here's a nice personal finance example of that. And we go back to using the calculator again. And here's Excel. And in Excel, again, you use the future value function here. And you just change the number of compounding periods. So it's important you just watch all how to do this here. So study this and go through this. If you have any questions, let me know. Okay. I'm going to skip continuous compounding because a lot of people don't know the exponential function. All right. So I'll end this right here, and I'll pick up on the next video of nominal and effective annual rates of interest.